Well, welcome to the Concierge Medicine Forum. This is a special treat. We have a good friend and a special, unique speaker in the finance world, talking with our physicians and nurses and those listening, and your staff and your spouses, maybe even as well. We have Chris Staples. He is a certified financial planner, but also an accredited investment fiduciary. So, in short, it's Chris Staples, CFP, AIF for those that are in the financial sector and understand what those terms mean. He is with Wealth 360. So, Chris, thank you for joining us again as a repeat speaker. You were so popular last year at our live and in-person Concierge Medicine Forum, and we will be back live and in person hopefully next year again. But thanks for joining us again.
Yeah, thank you, Mike. I really want to start off by saying how much I appreciate you inviting me to speak again. I had a wonderful time last year, met a lot of wonderful people, and just really encouraged to continue to share some of the information to the audience that I think is both beneficial and practical. So looking forward to it.
And we've had some really intriguing conversations, offline about, what is happening in the healthcare world, what is happening inside of doctors' offices. And so we kind of narrowed some of the talk down today to some of the most pressing financial concerns that many physicians listening may have. And so I'm going to let you share some of your screen. We will have some Q&As afterwards. But let me just say for the audience listening too, if you have questions for Chris and you want to reach out to Chris, we're going to put his links to wealth360advisors.com. We'll put that in the links above and below, as well as how to get in touch with Chris in the best way. But if you have questions, again, this is a public forum and we're not going to speak about anything, so mind your privacy is what I'm saying. If you're leaving a comment, you don't want to leave too much information because other people will see it. This is a public forum. And if you have things you want to ask Chris, leave them in the comments or email events@conciergemedicinetoday.com, and we'll forward those inquiries on to Chris and let you two take the conversation from there. So Chris, I'm going to let you go ahead and share your screen and let's dive right in.
Absolutely. So what we're going to cover, two things before I show to the screen is one, last year, part of the presentation was really speaking about your business valuation. And that seemed to get a lot of traction. A lot of questions were asked and seems to be a popular topic. And I think even more popular today as well. And so predominantly, we're going to be speaking to that. And so we'll go through that. And then if we have time at the end, also some questions have coming up. This is an election year. 2020 seems to be quite the ride, and the election hasn't changed much of that ride for us. And so if we do have time, I've got some data that I can share that looks at the markets in context to an election year and then the terms afterwards. And so I'm happy to cover that as well, but predominantly we're going to be talking about what your practice is worth. So let me get set up here and just let me know that you can see everything okay.
Okay.
Are you seeing my?
Yes, we see a blue screen with what's your practice worth.
All right. You see it okay?
Yep.
And can you see my pointer okay? We're working?
Yep.
Perfect. All right. So first of all, a disclosure. We always have to add these in. So first of all, I want to make sure that the audience is aware this is not intended to be advice. It's for educational purposes only. Calculations are illustrative in nature, and valuation models shown should not be taken as recommendations. And I do say, seek the help of a professional advisor if you're looking at getting a specific valuation for yourself. But with that being said, let's move on. My goal here and the purpose is to inform and empower the owner operator. So the physician owner, we want to make sure that you get the information you need, and that information empowers you to be able to understand how to value your firm or your practice. And if someone is valuing it for you, what you need to be paying attention to so you actually have power at the negotiation table. One of the problems that we're seeing is not knowing what your business is worth. And if you don't know what your business is worth and you do want to sell it, whether that's an internal transfer or an external, which is to a third party, if you do want to sell the practice, then you become vulnerable because someone else is setting that price for you. So you just need to be aware of the data. And we're going to cover that. So some of the challenges is cutting through the jargon and then focusing on the data that matters, because I'm going to show you just changing a few things can have a large impact on outcomes. We're going to explore the various pricing models that are used. And for today, though, our case study is going to be really focused on a small business. And when I say small business, this is something that's $2 million of revenue. So, small is in the context of the audience. But in any case, we're going to explore the various pricing models. And then at the end, we're going to have some actions that what you can do now in order to help improve the valuation of your company, whether that's going to be 5 years from now or 10 years. What things can you be focused on today to improve the value of that business? So some of the common reasons that you want to know the value of your practice is, number one, succession planning. You may want to do an internal ownership transfer to another physician, and you want to know the value because if someone is buying and you're selling, setting that value gives you a good plan moving forward. You also may want to be doing business planning. You may have a specific goal over time that you want to reach. Well, knowing the value of your practice is going to give you direction for building that future value that you're trying to achieve. Continuity planning. This is planning in the face of unforeseen events. If something happens to you, become disabled or partially disabled, if you have no plan in place, the value of your business can be discounted drastically and even down to zero. So by doing some planning, and in this case, continuity planning, then you're maintaining the value of that asset. And in some cases, a business owner's greatest asset is the value of the business. And so what we want to do is keep the integrity of that business. And then one of the others, the fourth, is sale planning, basically preparing that practice or preparing that business to be sold to a third party. There are things that you can do today that will help drive the metrics in a positive direction or a premium that when you get ready to sell, you'll be able to sit at the negotiating table and possibly get a higher multiple for what that business is worth compared to today if you do nothing. So let's go ahead and jump into some of the common valuation models. And we're not going to spend a lot of time here, but this is going to be some of the context of what we're talking about today. So there is a discounted cash flow model. Basically, all it is you're taking the future cash flows and you're discounting them to present value. It does consider the size, the growth, and the risk variables within a company for the buyer. And also, one of the problems with that is the difficulty to explain or calculate because I'm going to show you some of the math behind it today. But there's a lot of points of data that become points of contention or disagreements. These could be the cash flow forecast or discount rates applied. And we'll talk more about the discount rate. Well, then you have multiples. You can have multiple of revenue, which is just what's the firm's earnings. And these are the top of the line. It's easy to calculate and communicate, but it doesn't consider unique attributes. It ignores expenses and other cash flows. You can have multiples of EBITDA or EBIT, which is earnings before interest, taxes, depreciation, and amortization, or earnings before interest and taxes. That, again, is easy to communicate. You can calculate that year to year. Again, there's some conflicting agreements on what's included or what should be added back. And, parties may say, I want to add this back. One of the other parties say, you don't need to add that back. And so there's some things that have to be looked at in detail there, depending on the business. That's usually more for larger enterprises. And so today's focus is going to be a multiple of EBOC or SDE, which is earnings before owner's comp or seller's discretionary earnings. That is tailored to a unique characteristics of business owner operator. And that's what we're talking about today, a owner operated enterprise. Some of the cons about that, though, is there's limited industry data to support findings. And so by applying a multiple of EBOC, you may have a challenge on going out and finding other comps out there to justify the multiple of that. However, today we're going to be using some analysis on using EBITDA or EBIT versus EBOC. And then we're also going to be using a discounted cash flow model to kind of justify some of the multiples. And again, this is for illustrative purposes only. It doesn't mean that this is how you should value your practice. However, I think it's going to be eye-opening in the aspect that it'll give you an idea of what that cash flow that you have is actually worth. So again, the case study today, I've already mentioned this, single owner operated business, and typically one physician with a small staff. So here is an example, very simple income expense that we're looking at. In this case study, we'll say a total practice revenue of $1.25 million. Then we have some direct expenses, which is owner's compensation, and then non-owner's compensation, which reduces that revenue down to a gross profit of $400,000. And then let's say this practice has overhead expenses of $250,000. So what we end up with is net profit before taxes of $150,000. So before we go into this, I want to reemphasize, we're going to be looking at this through EBITDA or EBIT, and then EBOC or STE. So that's going to be earnings before interest and taxes as your net profit, or seller's discretionary earning, or net benefit to owner, or earnings before owner's comp. The only difference when we look at EBITDA or EBIT, it's net profits before tax plus add backs. Those add backs are typically depreciation and amortization. But again, that's more common for large companies where the owner does not operate the business. EBOC, earnings before owner's comp, that is more typical of smaller owned business where you do have your net profits before tax plus add backs, and those add backs would be owner's salary and benefits. And so you'll see that play out as we move forward. So right now we're going to take a look at, well, what if this is your setup? You've got a practice revenue of $1.25 million. At the end of it, you have net profit before taxes of $150,000. So your EBITDA or EBIT. And someone comes to you, a buyer comes to you and says, hey, I want to give you a 2 times multiple of your net profit before taxes. Well, if you're using $150,000 as that net profit, then 2 times multiple is they're going to offer you $300,000. Well, you may be satisfied with that. However, is it good? Is it right? Or can you justify a higher number? Because if we look at $300,000 for this particular setup, it is basically a 0.24 multiple of revenue. So the revenue would pay back the seller just top line revenue over a period of just a few months. But if we're using the net profit before tax, the EBIT or EBITDA, it would take them 2 years to make back that $300,000. And, 2 times EBITDA may be justified in their mind. But let's take a step forward and let's compare that multiple of 2. We're still going to stick with a 2 times a multiple, but it's a 2 time multiple of what? So now we're going to look at earnings before owner's comp, or we're including seller's discretionary earnings. We have the same information here. Total practice revenue, owner's comp, non-owner's comp, overhead expenses, net profit again before taxes, $150,000. But if you're looking at an owner-operated business, you can justify the idea of adding back seller's discretionary earnings, because if that owner is selling this business, and typically they're selling this intrinsic value of cash flow to a buyer, so the owner's not going to stay in the business. They're not going to operate in that business. And if that's the case, all of those earnings, those seller's discretionary earnings, are coming back to the buyer. That's a benefit to the buyer. And so that needs to be accounted for in the sale of the practice. And so what you end up with now is a EBOC, earnings before owner's comp, of $750,000. So now when we look at using a 2 times multiple on that, that changes the valuation to $1.5 million, because the cash flow that's being purchased is $750 and not $150, because the owner, as long as the owner is not staying involved in the practice and pulling a salary, then the buyer is buying the owner's benefit, which is their compensation. And so now we see with a 2 times multiple, if you use a 2 times a multiple on earnings before owner's comp, That's a $1.5 million valuation, and it's 1.2 of revenue. There's a huge difference there. And that's only by looking at, are you looking at EBITDA or EBIT or EBOC with seller's discretionary earnings? So when we compare those two together, if someone who's using EBITDA wants to buy a business and they're looking at it with not adding back owner's comp, they're going to offer this 300,000 at a 2 times cash flow, and they're going to justify that because they are seeing this as an investor. It's going to take me 2 years to recoup my investment. But if you come back and say, well, hey, look, it's not 150, it's 750. If they're thinking EBITDA and you're talking EBOC, they're going to say, well, wait a minute, I'm not going to wait 10 years to recoup. But then that's where you have the power of negotiation and say, well, hey, you're not buying the EBITDA, you're buying EBOC because you're also buying my seller's discretionary earnings, my owner's comp. You're actually pulling that back as cash flow. So we're still using a 2 times cash flow multiple, but by changing it from EBITDA to EBOC, you've increased the value of that business by 5 times. And so by looking at it this way, the actual fair value could be somewhere between 300,000 and 1.5 million. But just by knowing you as the business owner are also giving up your seller's discretionary earnings that's going back into the cash flow equation, and that's the cash flow that's being purchased, well, you can justify negotiating much higher number, but you're still using a multiple of 2. And I'm not saying you should use a multiple of 2, but in this scenario, so you can see there's a wide disparity just because of the way you look at the practice. And so I would urge you to keep this in mind and understand, if someone a buyer is offering to you, the owner, a multiple of something, what is that multiple of? If it's EBITDA and you're selling the whole practice and they're buying cash flow, well, are you being discounted to the point that it doesn't make sense to even sell the practice? And so this gives you a little bit different way of looking at it.
Wow.
So what we're going to do now is let's look at to see if we can justify those multiples by using a discounted cash flow. So really, all this is, the valuation is the cash flow divided by the risk minus the growth. And this will play out. So really, the risk is the discount rate that an investor is going to apply, because they're saying, how much do I need to earn on my investment to justify the price I'm willing to pay for this cash flow? So let's take a look at how that plays out. So here, if you can see here, we're going to be using a growth rate of 3%, and we're going to be using a discount rate of 15. So this discount rate, again, is saying the buyer is saying to the seller, I need to earn at least a 15% rate of return on my money to justify me making an investment into this company. So what does the cash flow say? Even if we're using EBITDA, let's say that cash flow is 150,000, and then we have 4 periods here, and then we're going to calculate something called terminal value. Now, this is a very simplified version of discounted cash flow, but what we're using this for today is to justify how some of these multiples could be higher, and we can see that the valuation of the company could be actually set higher, because again, the buyer is buying this cash flow. And so if we take and we grow this estimated cash flow over from the start to period 1 at 3%, period 2, period 3, period 4, and then here we're using this discount rate, because if we're growing the cash flow, that's future cash flow. So we want to convert this into present value. So here, period 1, we're converting the present value of the 154 down to 134. Period 2, the longer you go out, you discount it. It's having a bigger impact on discounting. So period 2, we're discounting it down to 120. Period 3, so on and so forth. And then if you're looking at buying this cash flow, if it goes further than 5 years or 6 years, then you've got to come up with a way to value that perpetual cash flow. And that's called terminal value. And by doing this, you are going to be discounting all these like period 5 and forward numbers back to present value to get somewhat of a fair valuation if you're using a discounted cash flow model. So in this case, what we're going to do is we're going to lower the growth rate to what we would call the perpetual growth rate. Now, these numbers we're just using as an example. Your growth rate and your perpetual growth rate can certainly be different. The discount rate could be different. But in this case, your perpetual growth rate usually is going to be a little bit less because the longer you go out on a timeline, the more uncertainty you inject into the calculation. So what we're going to do is we're going to take the period 4, use a 2% growth rate instead of 3. We've got our period 5 going forward. And then this is where the valuation comes in, to where we're going to take the cash flow divided by the discount rate minus the growth. We get a terminal value of 1.3 million. We put this up in the terminal value. We discount it again back to present value, and then we add these numbers up. Well, by doing that, we get a total present value of $150,000 cash flow of 1.1 million. So when we actually line these up, we can see if EBITDA is being used as a 2 times multiple, compared to using EBOC, earnings before owner's comp, as a 2-time multiple, compared to a discounted cash flow just using EBITDA, we can see these different variations. And when we look across the board here on EBOC, it kind of closely aligns. But if you are selling a business using a low number like EBITDA, and we look at it back to EBOC, that means that if someone were to buy your cash flow and pay $300,000 for this $150,000 a year cash flow, it's only going to take them about 5 months to recoup their investment versus 2 years. If we use the discounted cash flow model, it takes them about 1.5 years. So all I'm saying is, by using the discounted cash flow model, and again, these variables, the discount rate could be changed. It could be higher because the buyer is deeming it to be more risk. The higher the discount rate is, the higher risk the buyer is saying that this cash flow has. But if we look at EBOC with the discounted cash flow of EBITDA, you get numbers that are close. So it's just a way to validate, does buying $150,000 worth of cash flow at those variables make sense? Well, it certainly could. But knowing how these calculations are made is going to empower you, the seller, when you're at a negotiating table, to look at a number and say, you know what, this really doesn't make sense because I know my cash flow is worth more than this. Let's take this one step further. What if we used EBOC? What if we use EBOC as our current cash flow, which is the 750? We use the same growth rate, but we discounted it by 50%. Now, when I'm saying discount rate of 50%, the buyer is telling the seller, I need to earn 50% on my investment in order for this investment to be worth it. So we're using a very large discount rate. Well, if we run the same scenario, we end up with a valuation, total present value, of $1.5 million on that $750,000 cash flow. So when we look at these all combined, if we're using EBITDA as a 2 times multiple, it is way out of range. But when we look at EBOC 2 times, discounted cash flow EBITDA with a lower discount rate versus a discounted cash flow using EBOC with a higher discount rate, you can see how these numbers are more closely aligned. Now, again, illustrative purposes only. What I do want to show you here, and what I am showing you, is that your cash flow could be worth a lot more than what some buyers are willing to pay for it. And if you don't know how they're coming up with it, nor do you know how to calculate it yourself, then you could be losing a lot of money, or be leaving a lot of money on the table. Because for most business owners to develop the kind of cash flows they have, it's taken a lot of years to build their practices, a lot of money, and a lot of work. And so if that's the case, this being one of your largest assets, you certainly don't want to discount yourself down so far that you leave so much value on the table. Considerations for discounts versus premiums. Well, like we talked about before, will the seller continue working as a physician? Well, if the owner operator will stay on staff, you have to account for that, and you can adjust the cash flows. And just going back to looking like, well, what is the physician going to earn? What kind of expense is that going to be to the buyer? You adjust that, and then you use a correct multiple. If you want to use a discounted cash flow model, you can use that, but at least you get a fair valuation. Also, something to consider is the type of revenue. So with the concierge practice, it tends to be more membership or reoccurring versus service-based or transactional. Reoccurring revenue could certainly be looked on as a premium because it's consistent and you know what you expect every year versus something that's service-based or transactional. It's very reactive because you will make money when someone walks through the door. But with a membership, you're making money based on someone who is has a proactive approach to doing business with you because they are purchasing that membership. Also, the demographics of your membership base. If you've got a patient base that the average age is 50 versus the average age of 70, that's a 20-year delta. Someone buying that needs to take that in consideration because if you have a younger membership base, that could possibly be a premium for you as a seller because that's a longer time frame for potential for a potential client or potential patient that's going to be paying. Also, one thing that needs to be considered is synergies between the buyer and the seller. If a seller comes to a buyer and they're purchasing the same type of client, they can plug them typically into their system without changing much of their cost structure because the same systems that serve the seller also serve the buyer. So in some cases, they're just buying intrinsic value, which is that cash flow. So if that's the case, if a buyer and a seller operate very similar, then the seller could say this is a premium because you're just going to take my customer base, my client base, my patient base, and plug it right into your system. And that certainly is a premium for the seller. And also, you look at turnover or attrition rate of member patients. If you have a very low turnover, you have a we'll use the term sticky, if you have a very sticky practice where a member has been a member and a paying member for quite some time, if you have a very low attrition rate, then that also could add value to the seller or become a premium. And these are just few of the things to look at. But again,
Hang on. You might want to reverse maybe 30 seconds because your mic cut out.
where was I?
Just pick up talk about maybe just after you talked about synergies between buyer and seller.
Okay.
Just after that.
I'll just pick up synergies and I'll get there. So, one thing that you want to be looking at is are there synergies between a buyer and a seller? And synergies, what I mean by that, if the buyer and the seller have the same type of business, that means the seller's client base or the seller's patients will be able to plug right in to the buyer's business model. And in some cases, the buyer is not going to increase much of their cost structure by acquiring the seller's cash flow. And if that's the case, the seller could negotiate that and say, hey, that's a premium because you're able to take this cash flow at not much additional cost. Also, with the seller looking at their turnover or attrition rate of their member patients, if that seller has a very low turnover or very low attrition rate, then we would use the term that's sticky. And that could also be a premium because those member patients are more inclined to stay than they are to leave because they're used to that type of business structure. And so that could also play a role as well. And these are not all of the considerations, but these are just some of the few that you would look at in your own practice to identify and say, hey, do these play a role in what I'm doing? And do they add a premium? Or is it something I need to discount? And that's something that happens at, of course, the negotiation table. Common pitfalls, procrastination. If you wait too long to address the situation evaluations, your option becomes very limited. You have a practice, you've been running for several years, and you get ready to exit, whether that's going to be an internal transfer or a third party transfer to an outside organization or another physician. If you haven't set this up to create to create value over time, those options begin to diminish. So, by just procrastinating, you can lower what the company or what your business is going to be worth over time. Also, prioritization. The question I would ask is, what are you trying to accomplish in your business? Are you trying to create a legacy? Are you trying to maximize a financial outcome? Well, by addressing your valuation earlier rather than later, you can begin to improve on key performance indicators, or you can begin to improve on those metrics that drive the bottom line. Because earlier, if you remember, we had talked about the cash flow being used. So if you can get that bottom line, whether it's EBITDA or EBOC, if you can get that bottom line to increase, well, of course, it's going to increase when you add a multiple to it. And so the idea is like, how can you improve the bottom line? What are you improving? What cash flow are you improving that you're going to be selling? Emotions. In some cases, you may run into unexpected emotions that can create roadblocks. Sometimes businesses are like your children. You've built it from scratch, you've grown it, and so you have some emotional attachments. And by getting ahead of the game and kind of getting an idea of what your value is, what the value of your company is worth versus what you think it's worth, can help to mitigate some of those emotions down the road when it's time. Also, execution. You need to be organized. You need to have a plan and be prepared to follow through with that plan. If you don't have a plan, there's I don't really recall who said it, but if you don't have a plan, someone else is going to have a plan for you. And so I think it's better for you to be prepared and create that plan. Also, some other common pitfalls: who's representing you in the sale? Is the same person representing the buyer and the seller? If that's the case, then whose interest is being served? So again, it goes back to the very first statement: is you want to be informed, because if you are informed, not that you need to know how to value your company, but if you know what metrics are being used and what data is being applied, what discounts and premiums are being applied, or what add backs are being applied, and it changes your bottom line number, then you can negotiate and you have power at the negotiation table. So again, I just encourage you to understand these things so you actually know what that cash flow is worth. Some things you can do today. Like we talked about, you want to identify some efficiencies that can increase your operating income, because earlier on we saw how just by changing the operating income and not changing the multiple of what someone is willing to pay, it's a starkly different outcome on what the company's value is going to be. Also, I would encourage you to get familiar with some of the different valuation models, because whether you're doing an internal sell or an external sell, someone may use a different model to value your practice. And if you have at least an idea of what they're using, then you have power to negotiate because you're seeing those numbers. You also want to identify discounts and or premiums to cash flow. Again, it goes back to how can you increase that operating income that you're actually going to be selling. Also, identifying potential partners for internal ownership transfer. If you can get someone way ahead of the game, whether it's 5 or 10 years before that transfer begins, well, you're adding value, because you've already developed a relationship with your patients. But if you also have an internal transfer idea, and that's what you want to do, you're allowing those patients to also develop a relationship with the new owner that will purchase this business down the road. Also, if you're looking at doing a third party, identify these third party buyers. Find out how they're pricing these cash flows, or how they price in these businesses. And that way you can set yourself up to know who you might want to sell to, how you need to price your own practice, and how you need to negotiate at the table. And then, get a current valuation and identify those key performance indicators, so you know what you can be focused on for the next several years if the intent is to sell that practice at some point in time. Well, that's all I have for the day. And again, if there's any questions, you are more than welcome to shoot me an email or give me a phone call. I'll be happy to do that. Yeah.
Uh, no, go ahead.
I was going to say, I was going to turn this back over to you, Mike, unless you had any questions.
Yeah, so we've had a few questions come in, and we want to ask those. They kind of dovetail into 3 or 4 different topics. So if we don't get to all of your questions, or you have more questions, or you're listening to the replay of this, Chris's contact information is right there in front of you. You'll be able to watch this throughout the next 6 weeks until December 31st. As a registered attendee of the 2020 and 2021 Concierge Medicine Forum here. And again, this is incredible information, incredibly valuable, as there is this kind of senior exodus of many older physicians who started 10, 15, 20 years ago in concierge medicine, and they're looking to leave well or finish well, as we say. And so a couple of the questions that have come in we is where should I start to look for a qualified buyer?
Well, it depends. That's a great question, and one of the things that I would emphasize is, are you wanting to do an internal transfer succession planning to someone who would be working in the practice with you, and are you going to slowly move the ownership of that practice to that person that may start out as an employee physician that ends up turning into a partner and then the owner? Or are you looking to sell to a third party external buyer? And if you're looking at an internal, then I would definitely begin to reach out and look for, people in the industry that are, lack of a better term, and you may have a better word for it, but a headhunter that could identify a physician who has a high level of interest in a concierge business model, and they want to be a concierge physician, and invite them into that conversation. And if that works out, of course, then you can bring that person on and begin to script a path where that transition takes place. If you're looking for, a third party, again, I think, that Mike has some great resources where you could begin to identify organizations that are actively purchasing those, and then make contact with them and get an idea of what they're actually looking for. And that way you can begin to look at your own key performance indicators, your own efficiencies, your own bottom line, and be able to increase that bottom line in order to help you get the most value for your company when it's time for you to exit.
And you're listening to and learning from Chris Staples. He is a certified financial planner as well as an accredited investment fiduciary at Wealth 360. His contact information is up there. Our next question comes in as looks like, how many quotes should I be receiving when I'm getting these models back? How many is the right one? I mean, should I just go with the highest bidder, or I've got multiple offers on the table, but they're using different models. How should I get help?
Yeah, that again, excellent question. I think a lot of that is subjective in the sense, because let's say, for instance, you have two offers come in, and one offer is higher. We'll say offer A is higher than offer B. And maybe it's not by enough of a margin because the money is not the bigger issue. Now, if there's a huge margin, then of course that needs to be renegotiated. But if there's not a big margin, then where are your patients going? And if you see that option B may be offering a little bit lower valuation, but you identify better for that the buyer, and maybe it's a very good fit. You feel comfortable with your patients going. I mean, that's something to look at. But again, that's very subjective. How many quotes you need to get? I think it depends. If you've got an internal buyer versus an external buyer, those could be two separate processes. But if you have like two third-party purchasers, then, you're going to want to get the quote from them, because again, they're going to be setting their own numbers. But that goes back to the point I made earlier. Then are you going to be representing yourself? Are you going to go out and have a valuation done where you have representation that's in your interest, that's on your side of the table? And so in that case, you really just have two. You have one that the buyer brings to the table, that's their valuation, and you have a valuation that you bring to the table, whether that's something that you have done yourself through looking at how these models work and pricing your own cash flow to present value, or you have a third-party professional that you have brought to the table that has done this for you.
And our last, well, it's not our last question, but it's our last question on the topic of what is your practice worth? And you're listening to and learning from Chris Staples, CFP and AIF at Wealth 360. And as you might think about your position as a listener, as a physician owner operator, there are a lot of fact dependent things that are probably popping up in your mind. And so, the last question really kind of circles around the key performance indicators. What are those? And, we talked with an attorney here at CMT, not too, maybe earlier in the pandemic, and she was giving resources and insights to physicians saying, start the preparation evaluation early, because what your practice might be worth today, if you just tweaked a few things, fixed a few things, put a few processes in, monitored and got engaged and locked in on a few key performance indicators. In a year or two, that practice may be worth very much differently in a value than what it is today with just a few things. So, what are maybe some of those things that physicians should be considerate of as they consider the process of retirement or leaving a legacy or selling internally or externally within the next maybe year to 5 years?
Yeah, I think one of the things that really sticks out is, and depending again how long of a runway you have. If you have 10 years compared to 2 years, well, of course, I think the KPIs are going to be a little bit different. But the demographics that you serve, really get a good understanding of the demographics, and really in this case, the age of your demographics. Because if you do end up you able to move those demographics, on average younger, because you're targeting and picking up newer concierge members or member patients that are younger, then that is a longer runway for the buyer, because that individual has as long as they stay as a paying member, they typically, barring the fact that something happens with their health, of course, they have a longer time to pay into that. So demographics is one. There's also some other variables is, can you create efficiencies in your operations? I mean, be looking at your business as a whole. Is there a way that you can cut costs that are overhead costs that are really they're not helping you? And by identifying some of these, at the end of the day, what you're doing is you're increasing that pre-tax profit, that pre-tax cash flow. And by increasing that pre-tax cash flow, what you're inevitably doing is you are able to have a higher number with a higher multiple, or a higher number that is going to be applied in a discounted cash flow model, or something along those lines. Another thing is in your practice, how sticky can you make your practice? Because if you have member patients that you're offering a select few things to, but if you can offer more things to those patients, then that kind of becomes more of a sticky business. And when the buyer's buying that, then they're buying something that could be a premium to your cash flow as well. So those are just a few. And I think depending on the business owner, depending on the practice, the culture of the practice, I think each one could have different KPIs. Some are going to be similar. Also, another thing to look at is like how much member revenue is generated versus service revenue, because I think that can play a role, because one is reoccurring, consistent, one is transactional. I think those are some variables to pay attention to as well.
And we're coming in for a landing on our lightning round of a couple of more questions for Chris Staples. He's the CFP and AIF at Wealth 360. The information, of course, is right in front of you. So if you have questions, comments, engage with Chris and the team there at Wealth 360. And I think that this has been incredibly insightful. So now we move to the lightning round of questions, which is taking our focus off of the lens of evaluating your practice and more from a, uh, I'm a busy physician. I'm worried about the pandemic and what it's doing to my retirement planning. I'm worried about the legacy that I'm leaving. I'm also concerned about, the crystal ball of the present.